All right, my gangsters and my gangsterettes. Welcome to an all-new edition of What Are Your Thoughts? Thank you guys for joining us on the live. My name is Downtown Josh Brown. With me, as always, my co-host, Mr. Michael Batnick. Michael, say hello to the folks. Thanks for that. This is partially enjoyed
for the
via
audio. Hello, listeners. Welcome.
Wow, what a guy. Hey, guys. So great to see everybody. I wanted to say a couple of quick hellos in the chat, and then we'll get right down to business. It's earnings season, of course. Roger's here. Jack is here. Gregory Mark. MK, what's up? Nick P. Rachel and Chris are here. Matt Dodge is here. Nick Kaspersky. Let's see who else. Jeff Asola. Gary Walter. Drew Hickman. Nice to see everybody tonight. Thanks for tuning in. Michael, who's our sponsor?
It is U.S. Benchmark Series, an FM property. John, throw up this chart. All right, this is a very, very interesting. I actually wrote about this the other day. What we're looking at here is interest rate scenario analysis. So what U.S. Benchmark Series has that's really unique are they target different maturities. So they've got a 3-month bill ETF, U.S. Treasury 3-month bill ETF. They've got a 6-month, they've got a 10-year, they've got a lot. And actually, if you look at like the total assets in these things, it really says a lot about investor preference. So for example, the 3-month T-bill, Josh, ETF has $2.4 billion in assets.
Can I stop you and ask a question? Because I'm not as familiar with this as you are. When you say they target, it says chart off 2-year Treasury. So if you buy it now, the fund actually matures in 2 years like a bond. It's not an ETF that lives forever.
No, they're continuously targeting that area of the curve.
Okay, all right. So they're just giving you what the maturities are in that.
Yeah, but it's interesting because, like I said, they have $2.4 billion in the 3-month.
Yeah.
500 million in the 6-month, and then in the 10-year, only 60 million. Nobody wants duration.
Nobody wants the duration.
But chart back on. Chart back on. Okay, so what this is showing you is the asymmetric, in my opinion. Well, not my opinion. This is a fact. These are just math. Risk reward in bonds. So look at the 10-year Treasury, for example. So when they made this, it was yielding 4.46%. That's like in the middle. You see it? 4.46% for the 10-year Treasury.
Yeah. So
this is showing you what happens 12 months from now if rates go up 50 basis points or down 50 basis points or up 100. So what's interesting is this. So if rates go up 100 basis points, now this is called like convexity. It's the second derivative after duration. If rates go up 100 basis points over the next 12 months, this thing will lose 2.64% total return.
Yep.
Because you've already got the 4.5% starting buffer, right?
But
if rates go down 100 basis points, you've got the yields today plus whatever yield you're going to be getting plus
capital appreciation. Yeah.
So
you make, what is that, 12% on a 10-year?
12% if rates go down 100 basis points. You lose 2.6% if rates go up 100 basis points. This is over the next 12 months.
That the risk from here in something like a 10-year Treasury is fairly asymmetric. It is possible we get another 4 quarters worth of hikes from the Fed. Not likely based on current projections, but conceivable.
Right. Yeah.
So what? Who cares? Because the benefit of those first 4 rate cuts, even if they don't come for 2 years, is a much bigger payoff. Listen, I was talking shit about 10-year bonds today on LinkedIn. I don't care what anyone says. I'm a hungry hippo right here. I want to lock that shit in. I don't care if it goes to 6%. I want it now.
Can I say one more thing that's interesting that you might not know about? So a lot of the popular ETFs that will target like areas of the curve, 3 to 7, 7 to 10.
This is a specific maturity.
No, but listen. So if you're buying the 7 to 10, and not that there's anything inherently wrong with this, I'm just saying that is sort of like a market cap weighted ETF.
Yes.
What determines how much you're getting and where is how much the government is issuing at different spots. If you wanted to target a specific maturity, now you can do it.
And there are people that do, and increasingly more. So it's benchmark. Where do people learn more about this?
U.S. Treasury. What's this? It's USTreasuryETF.com. There you go.
All right.
USTreasuryETF.com. All right, let's get it on.
Okay. You're up.
Before we do, as Josh mentioned in the monologue, I know people are take it easy. We're going to Charlotte, but I'm asking with peace and love. With peace and love, there are no more tickets. We are sold out. So we what?
No, that's a good point. I feel bad.
We appreciate people continuing to reach out, but we have no more tickets left.
You know what we did? We didn't think big enough when we booked it. When we booked the event, and we know better for next time. We just
we've never been there before. We don't know.
You're just such a rock star that we just need a bigger,
Listen, I thought 10,000 seats would be enough, but apparently it's not.
By the way, shout out to Nicole for planning the whole thing. And if we closed you out, it's her fault. So just let her hear it in the chat.
All right, we're gonna go through. Really, we're gonna spend a little bit of time on Microsoft and Google. But before we do, just a couple of quick items. Coca-Cola. Apparently, people still like to eat sugar.
Yeah,
right? There's all this Ozempic stuff.
I thought everyone was going to be skinny.
Those stocks getting killed. It's had a pretty nice bounce off the lows. So Coca-Cola revenue, third quarter sales rose 8% to $12 billion. Analysts were expecting $11.44 billion. So, I think that was fairly predictable that Coca-Cola sales were not going to crash because a couple of people are losing weight. Last week we spoke about, I think it was last week, about LVMH. And stop! Get out of the chat. We're live.
No. One thing about stop. One thing.
Get out of the chat. You're distracted.
I'm not in the chat. One thing about Coca-Cola. So my friend that's on the Ozempic, you know him too. He smokes a pack of cigarettes a night now when he's out drinking, and you're not supposed to drink on that stuff also. And this is just, to me, this whole idea that like all of these junk food stocks and fast food stocks are going to zero. No way, dumb. Man. Have you met any human beings before in your life? Are you kidding me? All right. Sorry. Go ahead.
All right. So last week we spoke about LVMH and I said a luxury slowdown? A luxury slowdown?
Yeah.
Actually not. Hermes. Did I say that right? What do they make? Bags and stuff? Hermes?
Oh, dude. Leather goods. Yes.
Okay.
Yes. Bags.
So at the end of September 2023, all the geographical areas posted solid performance with growth above 20%. So I think year over year, that 22%. So I guess in like and that's real luxury, right?
Yeah. Well, Hermes is interesting. It's like, it's kind of off in its own world. It's super hot right now. The reason why the emblem is the horse and carriage, their original product, same as Louis Vuitton, was big steamer trunks for royalty. So you had a king or a queen or a duchess or a duke.
How do you know this?
Because I just know. And so that, but like, so I'm answering your question. What do they make? Like, yeah, you could buy a belt from Hermes for like $1,200. You could buy a silk scarf for $2,000, or you could buy like a giant, leather overnight bag for
so this is like this is expensive. This is not. This is aspirational. Oh my God, $1,075 sneaker. This is wealth.
Dude. This is not like Polo Ralph Lauren shit. This is like the next.
Good
like the real luxury.
There's a gentleman loafer. You could wear this gentleman loafer. It's $860. Outrageous. Anyway, they're on fire.
It's not even that much, dude. It's like Ferragamos are like $750 now.
$860 for a pair of loafers?
No, it's not a lot of money, but I'm saying it's not like outrageous.
I don't know. I'm wearing a $12 Gap shirt. So you're talking to the wrong guy.
Oh, that's fine. Listen, I'm wearing a Ritholtz Racing hoodie. It's fine.
There we go. So Visa, I didn't get a chance to look at the earning to really dig into the report yet, but revenue was $8.6 billion, over 8.55 expected, and earnings per share one beat. And Visa shares are trading not too far from an all-time high. Not too far.
I sold this too early. I sold this sometime in 21. Should have held it.
Yeah, but you made a lot of money. You held that for a long time.
I did really, really well with it, and I held it for like 10 years. But I probably should still be in it.
All right. You want to do this via Sean stuff, or can we skip over this?
Let's just like get right into Alphabet and Microsoft.
All right, Microsoft first.
Okay.
So this is from, we're just going to go through these charts. This is from Consensus Gurus, excuse me. This is an interesting table. It's showing the EPS beat or miss, and tonight they why do I keep saying they won? Tonight they beat. This is next column is showing the PE ratio into the print. This stock is trading at 30 times, as high as 34 in Q4 21, as low as 24 in Q1. And the stock reaction's kind of not been great I kind of in my head thought that Microsoft tended to do well, but it's been pretty much a mixed bag. Stock's up 5% in the after hours right now.
I think what's important here is that the best business they have, which is cloud, is reaccelerating. And that is really the most important thing to the stock. There's a lot that they do, and the AI stuff obviously is going to get a lot of headlines. 13% revenue growth at a company doing $56.5 billion per quarter. It's just a crazy growth rate. But what was really great in this report and why I think the stock knee-jerk rallied higher was Azure cloud business was
29.
up 29.
Yeah, and that had been coming down. So it had been coming down and it had a huge spike. 29 is definitely higher than it had been in some time. Let's talk to some of these charts. This is from Quarter, who, by the way, now I was listening before we hopped on. Quarter's got live earnings calls with live transcripts. It is remarkable. So speaking of remarkable, look at this business. So this is their 24 Q1 fiscal quarter. I don't know. Don't ask how they measure this shit. So 21.5 billion, which is a lot of EBIT. That's a lot of EBIT. Last a year ago, grew 25% year over year. 25% year over year.
26.9, yeah.
And if you compare it to the last quarter EBIT from the companies as follows. So Microsoft has done more earnings before interest and tax. That's what that means. Then Adobe, Salesforce, Tesla, ASML, Costco,
Netflix,
Nvidia. I missed Netflix. What's
combined.
that goat? Is that a reindeer? I don't know what that chart that is above Nvidia.
I believe that's
incredible.
General Goat. No. What
all right,
company has a goat is it's I don't know.
Let's keep going through some of this stuff. So, all right, just remarkable numbers. $56 billion in revenue.
Dude.
Gross margins at 70%, operating margins at 48%. I don't know how many times we've said this, but these companies just defy the laws of business as we know it. They just do.
Can I say one other thing? I think they have like $144 billion in cash now. So they said that AI related capital expenditures jumped 70% from this quarter last year, but to only 11.2 billion. And I know it's a lot of money. Like I don't mean it tongue in cheek. Like they're spending $11 billion to build out AI every quarter. It's a lot, but not compared to the rate at which they're piling cash up. And now if they're even vaguely attempting to cash manage their own cash pile, which you know they are.
Literally billions? Not probably. What are they earning on cash versus... Yeah, go ahead.
Didn't Barry and Chris, when they went out to Washington State, meet the treasurer of Microsoft?
Yes.
You think they kept in touch?
But Josh's point is...
probably working his ass off right now.
They locked in debt at 3% or thereabouts. And now they're getting 5+% of their cash. So 2%
on $150 billion. It's endless. They could spend more on AI than anyone, and not even disturb the cash flow. Really, it's amazing.
Not to go too far off on a tangent, but I was reading. Who did I share this with? I'm sorry, just one sec. This guy, Sam Lesson, had a report on the state of venture capital that I was sharing with you guys last night. And there might not be a lot of AI startup winners. That's like what his thesis was. These companies, it's going to be Microsoft and Google and Meta. They're just going to gobble up anybody that even remotely starts to have success. The biggest winners in AI are going to be the incumbents.
I want to just say one thing about that. I sort of agree, but with a twist. Like there are not a lot of internet companies per se. There are platforms, but it's just like a few. And then there are, I suppose, the telecom and cable companies that are providing broadband. I don't know if anybody would look at those and be like, what a big winner. Some of these stocks have been down 20 years straight, like Verizon. But whatever, like that's the whole internet. And then there's another layer of companies that have built on top of those big platforms and services. Those will exist. It could be 10 years before they even arrive.
So
that's like, that follows every pattern of every tech
But I don't know. But I
adoption
don't know.
curve we've ever
but
seen.
I don't know that old patterns extend out to where we are today. So he has a slide that says AI startups are wishful thinking by VCs. AI startups and their investors are going to get crushed. So he basically said that the incumbents. But then here's a great line. He said, "Even if you think I am wrong, and there are startup opportunities, the problem with any theme like AI is that the businesses will be so picked over and so outrageously priced, it isn't even worth bothering playing." There's so much more capital chasing hot startups today than there were even 10 years ago.
One thing that we forget, this is like the role of venture capital to lose a shitload of money in a tech transition for the benefit of the rest of us who are further downstream. We won't become billionaires as a result of what they do, but we will very calmly and casually grow $1 million into a couple of million based on the work that they're doing. And they have to invest in this stuff. They can't afford to miss something, and they have to own a lot of zeros. And we kind of forget that that's historically, that's what they do. And that's not, I think there was a 10-year period where everything just worked and there were few zeros. And if you couldn't take it public, you could SPAC it. If you couldn't SPAC it, you could do endless rounds in the private market, or you can do M&A. We're going to talk about M&A later. It's not usually like that. It's usually more like, hey, we invested in 20 things. This one thing worked out, paid for all the others, hopefully, and we did about 20% returns on the fund.
In the last
that's how it usually works.
In the last few years, we spoke about venture through the lens of an asset class, forgetting that how many things that we use today are venture-backed companies. It's actually an incredible thing. All right, whatever. Let's keep going. All right, Microsoft Cloud. Look at look at this growth. John, please, John. Back up one if you don't mind. Thank you. Okay, so Microsoft Cloud revenue in billions. So just go back to a year ago. They were doing 25.7 billion, then 27.1, then 28.5, then 33, and then 31.8. So the growth, it's 24. I'm sorry, year over year. It's crazy. It's crazy growth.
You're growing this segment.
And the margins
24%, and the margins are at 73%. They don't budge.
So
they don't budge.
There's no precedent in history for this.
No.
Next chart, please.
You can't model.
So Alex Moore said this is the Microsoft Cloud revenue run rate. So run rate revenues now exceed $127 billion. The entire company in fiscal year 2019 was $126 billion. All of Microsoft. Microsoft.
Somebody said that.
All of it.
The year Microsoft was founded, they did $16,000 in revenue. And now they do $16,000 in revenue every 2 seconds or something like that. I forget where I saw that, but it's, the superlatives that aren't enough. By the way, hold
on. Before we get to Google, Josh, when this is a good segue to Google. When we were talking a couple of weeks ago about ranking our Magnificent Seven for the rest of the year, I think you and I both had, well, of course we were going to lose. We had the exact same list. We had Google 1, Facebook 2, Microsoft 3, or NVIDIA 3?
No, NVIDIA. I think I had NVIDIA 2. I don't know.
We got to pull that up. All right, Google.
Whatever. It's already not going well.
Google is. Oh wait. 1 last thing. I'm sorry. One last thing on Microsoft. LinkedIn is still growing 8% a year.
Yeah, I told you. The best social. It's the best social network in existence. It's the only one that matters at this point. They're all. Facebook is over. Twitter is obviously a disaster. LinkedIn is the last one left, and Microsoft owns it, and it's pretty remarkable. All right. Alphabet's not so great. I don't really understand why, because
I was about to say, I'm not sure why it was
the
so bad
numbers
either.
look pretty good.
Yeah. Let's go
beat on revenue, beat on earnings.
YouTube.
Yeah, I mean all right, sales growth in the cloud division slowed to 22%, and we said Microsoft was positive 29%. So versus the third quarter last year, up 22%. It's not terrible. It's $8.4 billion of revenue.
It's our biggest engine of growth. So I guess that potentially slowing is what's hitting the stock.
But the thing is, it's just not that big. They're a very, very distant third to Amazon and Microsoft. So they only profited $266 million this quarter in the cloud. So it's not growing as fast as Microsoft's. It's smaller. And maybe it's short-sighted to, get bearish on it based on this one particular quarter, because there is no future for cloud computing where Google's not a huge player. But that's probably, if you ask me, like, what's the reason this is down and Microsoft's up, that would be my guess. What do you think?
Well, I'm sorry, I wasn't listening. I was getting ready for my next point. Sorry,
Okay.
I'm being honest.
Make it.
Now I forgot my next point. Damn it.
You're crushing it tonight.
I'm on fire.
One thing about...
Oh, I'm sorry. I recall my point. So Google and Facebook are important through the sense of that, like, if the economy was to be softening, which a lot of people say that we are softening right now, we're slowing down, ads are what goes first, right? Like the ads are the easiest knob to turn for businesses. And I'm sorry, you're just not seeing it yet. Well, I'm not sorry. It's actually a good thing. You're not seeing it yet.
Yeah. I think both of these companies are moved by what they say on conference calls and what kind of guidance they give. So we're like reacting to this stuff, with the news out for about an hour. But I think just overall on balance, these are still the companies that are in the best businesses on earth. And that's why you got 4 stocks worth $6 trillion reporting, in the next couple of days. These are just the best. These are the best of the best still. And none of that changes based on tonight's earnings. What's going on with Snap?
Hold on.
I forgot this thing was still public.
Yeah. One more thing on Google. So they said in January 2023, we announced a reduction of our workforce, and as a result, we recorded employee severance and related charges of $86 million and $2.1 billion for 3 and 9 months ended September 23. Unbelievable. In addition, we are taking actions to optimize our global office space. As a result, exit charges for the 9 months ended September were $649 million. The fact that they're able to do this, like, all right, $2.1 billion in severance. We're going to take a charge of $650 million for real estate. It's wild. And John, chart on, please. Exhibit number 6. Next one. We'll skip over this one. All right. We don't see any reports about the fact that tech layoffs have basically stopped. Remember, this was all over the place in late 2022, early 2023. It was nothing but, it was, another one. Now it's Amazon. Now it's Salesforce. Now, and guess what? It doesn't happen, and now the media doesn't report it anymore.
Well, I think this is going to factor in heavily in Amazon's quarter, and it's not even a tech company. Like, Amazon is a consumer discretionary, but like they're going to report Thursday, and I think like Amazon is going to have a great quarter profit-wise, because finally all the layoffs, the charges, the severance, all of that stuff is now baked into the cake, and a little bit of uptick in their business, like we just saw with these other companies, combined with that lower cost structure. And I think Amazon is in a position to not disappoint this time after a few disappointing quarters in a row. But you're right, you're not hearing as much about layoffs, and actually some of these companies seasonally had to hire back. Amazon's a really great example of that. So,
all right, John, let's end with Snapchat. Okay, so Snapchat, for a change. So I first grabbed it after I was like, oh my God, it's not down 15%. That seems to be the theme every quarter for the last couple of years.
It's such a piece of shit, but
yeah,
it has such a hold on the younger generation, though. They really use it.
Well, the rally pretty much faded. It's up 4% now, but I mean,
I wouldn't invest in it because I don't think they found a way to make money from that. But
look at the revenue.
What is it?
All right. So it troughed a couple of quarters ago. It's back on the way up. That's both in terms of like global revenue as well as average revenue per user. So not terrible. I mean,
the problem is like the revenue model just makes no sense to me. It's supposed to be advertising, and there is some content on Snap that's not kids sending messages to each other. The content just sucks, and Instagram kicks their ass at that. Snap is just super effective if you're 16 years old, all your friends are on it. It's the easiest way to keep in touch with everyone you know each day. You take a quick picture of yourself. Yeah, I just don't know where the business opportunity is there.
Yeah, they're still only doing $1 billion.
It reminds me of Twitter, quite frankly. And I think this has more users than Twitter. Is that possible?
Oh, yeah, it does.
Okay.
I think it does.
Yeah.
Actually, wait. Twitter had 300 million. Does Snap have more? Actually, about positive.
Honestly, who believes any of this bullshit?
Okay. All right. Let's move on. So that was that's earnings. So not bad. I mean, not bad at all.
All right. What do you want to say about small caps? This is you.
Yeah, this is me. Let's go through. John, can you just throw up some of these charts? Do we have these charts from Aaron Stanhope? So last week, Josh, we showed this chart that Aaron has recreated, right? Yeah. It was the maturity schedule of the S&P 500, which, again, not so bad. Small caps. He used the S&P 600. Same thing, Russell 2000. But Aaron was like, well, actually, next chart, please. Oh, do we not? Oh, we only have one? All right, my bad. I forgot to put this in the doc. But here's Aaron on the matter. So he says, when we break down small cap components by sector, the dominant part of maturities are in two sectors: real estate, big shock there, and communication services. And like half of the debt that's coming due. Half of the debt coming due is real estate and communication sectors. However, it turns out that the communication services, all of that debt is two firms, two fallen angels, Dish and Lumen Technologies. So absent, this is not like inflation X food X this. It's take two companies out and take out real estate, and it looks
out of 2,000 companies. Or
it looks wildly different. Yeah. So it's not to say that tighter financial conditions, higher cost of capital aren't impacting small stocks. Of course they are. I just thought it was a great reminder that like maybe don't take everything at face value, even things that seem objectively true.
We had this conversation last week about, or 2 weeks ago, about Amazon. We were talking about like this earnings season, what sectors are going to have the biggest earnings growth year over year. And I was saying to you, like, if you pull Amazon out, consumer discretionary is actually going to be negative, but leaving it in, it looks like the sector is growing its earnings by 22%. So that, yes, situational awareness. And actually, Sean gave me this. I didn't get to talk about it on CNBC today. If you take NVIDIA and their earnings growth this quarter out of the market, the S&P's earnings growth goes much more negative. And the tech sector goes from positive to negative. Listen to this. NVIDIA will be the number one contributor to earnings growth for the S&P tech sector. The whole sector should report 4.8% growth this quarter, year over year. Pull out NVIDIA, the growth rate is negative 2.9%.
Wow.
Think about how nuts that is.
Yeah.
That's just on the tech sector. On the S&P, if you pull NVIDIA out of this Q3 earnings season, the S&P goes from negative 0.4% to negative 1.8%. So that's one stock, not even the biggest stock in the market. I mean, one of the biggest. But yeah, there's a lot of distortions because we're talking about a handful of companies in each sector that drive the whole thing, and a handful of companies at the top of the S&P. And we should always keep that in mind when we're talking about market-related stuff. Got some M&A going on. Chevron is buying Hess. This is an all-stock deal. They're buying all of the outstanding shares in Hess. The transaction's valued at $53 billion or $171 per share. Hess shareholders are going to get 1.0250 shares of Chevron. So Chevron is going to issue new shares to pay for this. And if you include debt with the equity, this is going to cost Chevron $60 billion. And, this is I want to say more about more M&A later. This is a huge deal in dollar terms. I don't care how big Chevron is. I don't care how big Exxon is. These are very, very big deals happening. And I thought what was interesting, Hess, I think, is the second largest holding in IEO, which is an ETF we talk about all the time. Exxon 2 weeks ago announced they were buying the third largest holding, Pioneer. So these are the companies that are targets. These are domestic oil and natural gas producers. And IEO has, another 30 of these. And I just think it's interesting that the oil companies are using the relatively depressed valuations to buy up some really, really big names in the space. And I think it's super bullish for the whole sector. What are your thoughts?
So Pioneer is the fourth largest. Hess is the fifth largest. But do you think that Exxon and Chevron, I mean, they're done, right? They're out of the market. It's not like they're going to be buying like the seventh and eighth largest.
Yeah, no, these deals take like 15 months to close.
So does that mean that there's going to be consolidation at the smaller end?
Who knows? I just think it puts a floor under some of the valuations here is more important than who gets bought next, because who the hell knows. But I think just like understanding what Exxon and Chevron were willing to pay on a valuation basis for these names, that's like an important signal that these stocks are probably ownable, broadly speaking. And then we throw Oxy in there. Oxy is not M&A, but Berkshire Hathaway is buying every share that's not nailed down. Every time that stock drops under 60, they're adding to it. So I think there's a floor here for these stocks, and I don't know where the ceiling is.
I have some more charts in the M&A section, so let's put a pin in this and we'll come back to it.
Okay, you're up next.
All right. So I had this in the doc. I probably put this in on Thursday. Why is gold working? I could have also included why is Bitcoin working. And in terms of like gold, I think it's a
fake flight to safety.
What is?
That's why gold and Bitcoin are working. It's a fake flight to safety. It's a flight to fake safety. That's what I'm trying to say.
Which is both of them?
Yeah, dude, people have gotten their asses handed to them in treasuries, and they're just like, all right, I guess I'll buy gold. And then, if you're a lunatic, Bitcoin works better than gold. But like that's what's going on here.
Wait, what do you mean? Why are you antagonizing Bitcoiners? Only lunatics own Bitcoin. I own Bitcoin. Am I a lunatic?
I own Bitcoin. I am a lunatic. I'm going to tell you right now, the same people are going to get all bulled up on this, and then this stupid ETF is going to come out, and the price is going to fall.
Well, because you said so.
Crickets.
I mean, yeah.
It only happens. It only happens every time. Do you remember when the futures started trading?
Yes. Okay.
That was the top. Late 2017.
The other time that was top. No, what's interesting? Speaking of Bitcoin, was the actual bottom?
Yeah.
November
of last year.
When FTX blew up, that was the bottom. Kind of amazing how markets work. Like crypto aside, just the way that markets work. You would think that when FTX goes kablooey, what's left? Right? Like fucking A, this thing is unownable. What is even left here?
No.
If they're not around?
You at the time said, if you're looking for a reason to buy, the biggest brokerage on earth going bust, and this thing's still standing, that's the reason to buy. You were right. And that's what we call a clearing event. And every market sometimes needs a clearing event after an extended bear market. And that's what that was for Bitcoin. That was a clearing event. That was just every weekend out at once.
A great teachable moment that when it seems like the news could not possibly get worse, bottom. Yeah. All right. So anyway, my point with gold is that, listen, gold trades on a lot of different things. That's what makes it, I guess, appealing for some investors, is that it can be sort of a chameleon. But one thing that has been fairly clear, at least an intuitive case for or against gold, is that it trades inversely with real rates, right? If real rates are going up, it should make gold less compelling, right? Like, why would you hold gold? Doesn't do anything. So chart on, please. So the yellow line is gold, and gold had been hanging high much of this year despite real rates increasing. So the black line is real rates but inverted.
This chart looks great.
But the black line is inverted.
Yeah.
So you could see, right, it's negative. That means yields are going higher.
Yeah.
And it's far from 1-to-1, but nevertheless, it really is interesting to note the strength in real yields and the fact that gold is still hanging high with a strong dollar. Like, it's impressive.
I think gold is going to break out before the end of the year. There's not much time left, but it's been bumping its head up against 2,000 for a long time now.
It looks good.
I don't know why if you're in it right now, why would you sell it? There's a million reasons to want to buy it. I don't know why you would. What would be the reason to not want to be in gold, other than technicals? Like if it sells off, technically you might want to be out. But I'm saying, if you're like a gold believer, this is the time to own it.
If you're a gold believer, you're never selling. But the reason to sell gold is because you can get 5.5% in cash. Not saying that's why you should sell gold, but
but on the way up, when there's momentum behind the price of gold, which there kind of is right now, you're not worried about 5%.
Yep. All right, let's get back.
It could double.
Let's get back to M&A.
Okay. I think we take for granted that you need the IPO window for people to get exits. The IPO window is not going to reopen this year. That Birkenstock deal was some piece of shit. That was the final nail in the coffin of 2023's IPO window. The last couple of high-profile deals were just absolute trash. What was the one? What was the one that
Arm
Holdings?
Arm was
That's not
not
the one
great.
I was
But
thinking of, though.
Birkenstock's not that bad. It was Instacart.
Ugh. All right.
It's
Anyway,
gross. Yeah,
there is just here's the vibes right now. There is just not demand for anything like this. We tried a private equity held thing. We tried to bring that out, didn't work. We tried a profitable VC-backed startup like Instacart. That didn't work. We tried a popular consumer brand like Birkenstock. Nobody wanted that either. Just nobody wants it. So if that's the climate, probably the bailout here for the private markets is going to be M&A. And I know there's always M&A, but it just might be a more realistic exit if you need an exit in the next 6 months.
Aren't M&As always bigger than IPOs? Or maybe not always, but generally speaking?
Aren't there more buyouts than IPOs?
The M&A market is large. Yeah.
Normally. And keep in mind, like in 2021, those are not IPOs. Those SPACs are M&A. You know what I mean?
I guess,
like the SPAC does an IPO,
right,
but it has to buy a company. So it's technically it's M&A. But yeah, it shouldn't be that surprising. Bloomberg is talking just about M&A in general. Let's put this chart up first.
Woof.
So Fortune magazine is basically making the case that there are 1,200 venture-backed private companies on the verge of running out of money. And it's like it's high time that we see a turnaround in M&A to alleviate that, because they ain't coming out through the public window. Now, Bloomberg is talking about public market M&A. We've had $139 billion worth of takeovers in just the month of October. Did you know that? That's triple October of last year. It is the highest volume for any single month in terms of M&A since June of 2019.
And does this include the energy stuff, or is
Yes,
this like closed?
it's October.
Yeah, it does. Okay.
4 of the 5 biggest M&A deals globally this year have been announced in the last 2 months. And put that chart back up. October is the busiest month in years for U.S. company takeovers. This is, we're having a moment. We're having a moment. And maybe some of this has to do with like people feel like, all right, this is as high as rates are going to go. Maybe you just still have these depressed valuations going into the end of the year. People are looking for something smart to do. There's probably a whole confluence of reasons that we can't get into now. But it's not just the United States phenomenon. And it's not just energy. Roche Holdings, which is a big Swiss drug maker, they're buying a drug for $7.1 billion. There's an Indian steel company spending billions of dollars to buy Walt Disney's Indian operations. Microsoft closed the Activision deal. That's $69 billion after 2 years of regulatory hell. Then you have the Exxon deal. They say Devon Energy is looking at major acquisition targets. So there's a lot. Bristol Myers Squibb just bought a big biotech. There's a lot going on here, and I wouldn't be surprised if it continued. And I'd almost rather see this kind of activity than just buybacks. I think it's a more interesting market when companies get bought and then the whole sector has to be re-examined and rethought and maybe even re-rated. What do you think about that?
Well, it's certainly preferable to these companies being gobbled up by larger companies than being dumped on the public. That's for sure.
Yeah. The average premium is at a 25-year low.
All right, so let's get back to this.
It's only 9%.
No. This is only for energy stocks.
Okay.
So chart on, please. I apologize. Whoever the person at Bloomberg writing this, I forgot to put their name in the deck, but they say that the North American energy sector has seen $270 billion worth of M&A deals year to date, with the average share premium at a 25-year low of just above 9%. Between 1998 and 2022, the average premium was 26.5%. So I wonder if one of the reasons why, and I think they alluded to this in the article, the premiums aren't so large is because the companies have done well and chart off. And they're not exactly cashing out, right? These are not cash deals. They're still upside in these names. So now you have shares of Chevron, you have shares of Exxon. He also said where does this leave the rest of the industry? He said in a consolidating industry. In other words, why is Hess selling for a 10% premium? Like, why even do that? In a consolidating industry, one wants to sell early before the best buyers have satiated their appetite elsewhere. So that was.
I agree with that, and there's one other thing I would add to that, just from my own history as an investor. One of the things I used to always do wrong, and a lot of people that don't know any better used to do wrong, is if you think a sector is consolidating, buying like the lowest valued or cheapest or smallest company, like being like, oh, I'll buy the $8 one. It just doesn't work. Nobody buys the lowest quality name. The lowest quality name goes chapter 11 10 years later while you're riding it from 10 to $1. So if you are, for example, looking at these energy companies and you think there's going to be more consolidation, you'll probably be right. The highest quality assets are the ones that are going to get bought, not the lowest quality, because those assets can be ignored or replicated by better companies in the space. They don't need to buy them. So just a heads up.
All right, sticking with M&A. Let's talk about Morgan Stanley. So their investment banking revenue was below $1 billion for the first time in a long time. And here's a quote: "The minute you see the Fed indicate they've stopped raising rates, the M&A and underwriting calendar will explode because there is enormous pent-up activity. Boards of directors are sitting there saying, until we understand the cost of financing, it is very difficult to pull the trigger on some of these capital transactions."
I know there's pent-up activity. I just don't know if there's an appetite for it yet.
Pent-up activity. That's interesting. That's,
you know what I mean? They didn't say pent-up demand. The investors don't want any of this shit. There probably is pent-up activity, meaning there are a lot of issuers who would like to sell something to the public. The public doesn't want it. So that'll change, but I mean that's where we are right now.
So Morgan Stanley's underwriting is competing with the Federal Reserve, and so is their wealth management. Because when interest rates are 5%, and when you can get 5% plus on cash, people are in a lot less of a hurry, especially when it's not like the market is going up. In 2017, holy shit, I'm getting 1% on my bonds and the market is ripping. I have to do something. I need to speak with an advisor, right? Get me allocated. Well, now the market's whatever. The market's fine, but it's mostly going sideways. I'm getting 5.5% of my cash or 5.25%, whatever it is. I'm not like dying to speak to an advisor.
There's no FOMO in the stock market whatsoever.
So anyway, Morgan Stanley's wealth management net new asset flows sank by 45% year over year. That is insane. Now they're still doing numbers. $36 billion is nothing to sneeze at, but it was $65 billion a year ago. So that's a 60% sequential decline.
So they pulled in half the amount of net new money this quarter from a year ago quarter.
Unbelievable.
Yeah, the stock hit a 52-week low after they reported.
It looks awful. James Gorman. Now, I don't know if this is because they already plucked or they squeezed all the fruit out of E-Trade. I'm sure that's part of it.
I think they have to make another acquisition.
Oh, here's what I want to say. Robinhood. Morgan Stanley's going to buy Robinhood.
It's so off-brand, though.
Why?
Because it's just so low rent and shit.
Because Morgan Stanley is Morgan Stanley and Robinhood is
Morgan
Robinhood.
Stanley. It's the original white shoe firm. Morgan Stanley was a spinoff from J.P. Morgan. Like I mean, not that E-Trade was prestigious, but E-Trade was like obviously dying. Robinhood's not obviously dying, and it's a very different culture. And I don't know if you're a Robinhood user and you get an email like, "Hey, welcome to Morgan Stanley," you're probably like, "Fuck you, I'm out of here."
Fair.
I don't think that's
fair.
Fair. And looking at Goldman,
I'm not saying they should.
Let me finish trashing your opinion. Looking at Goldman Sachs and how much shit they're eating for all these junk consumer acquisitions and things they tried to do over the last 2 years, do you really think that James Gorman is sitting in his penthouse office like, let's do some of that? Like I feel like they're going to go the other way. I think they're going to buy like Fiserv. They're going to buy like a company that's really involved with the plumbing of finance and that's like has no public facing brand.
But they're all in on wealth management. Or they're not all, they're deep.
No. All right. I agree with you. But being all in on wealth management, all that means is that you need more funnels to feed the financial advisors with potential clients. You don't need you don't need a consumer facing acquisition to build that. You can they've done this like with all the businesses that they have where they service 401ks for Fortune 500 companies, or they service like stock option business, and then they feed that. Those are not publicly facing brands like a Robinhood or an E-Trade, but they have like a lot of customers. I think those are just better optically for Goldman and Morgan Stanley.
Well, I think they're going to do something. All right, let's talk about the mutual funds.
Not a fun business to be in right now. Mutual funds are in big trouble. One of the things that we talked about with Balchunas, there's this phenomenon where every time there's a market crash or like a big correction, what happens in the aftermath is that the money that came out of actively managed mutual funds goes right into index ETFs. And every time that happens, that's a big chunk of both dollars and investors who never come back. Mm-hmm. Like once you start building portfolios of ETFs, you're not like, you know what, I think I'm going to go back to using mutual funds. So that phenomenon has just been repeated so many times. And now I wouldn't say we're in a crash right now or even a correction, but we're still below the 2021 high for most stocks. And active managers are losing more assets under management, and it's becoming increasingly apparent that those assets they're losing are not coming back. This is a Bloomberg piece, money managers with $100 trillion confront end of bull market. And what they're basically saying is $127 billion out of T. Rowe Price in 2 years. Think about how much money that is. You know how hard it is to raise $127 billion in 2 years?
Yeah, it takes 50 years.
Franklin Resources, a 20-quarter, uninterrupted 20-quarter losing streak. And then they talk about Aberdeen across the Atlantic. It's England, Scotland, England, same shit. This is the direct quote. Across the $100 trillion asset management industry, money managers have confronted a tectonic shift in investor appetite for cheaper passive strategies over the last decade. We know that. Now they're facing something even more dire. The unprecedented run of bull markets that buoyed their investments and masked life-threatening vulnerabilities may be a thing of the past. So they were saying 90% of additional revenue taken in by money managers since 2006 came from the markets going up. Wow. The markets went up and up and up and up, and that masked the fact that these companies organically were not growing. They were just living on market growth. And now that seems to be over, at least right now, and it's just a really, really tough time to be an active manager running a mutual fund. And we know these people. We know that what the data is saying is being backed up by the anecdotes. It's so we have a couple of charts. I know how this ends.
Chart off. Go ahead. How does it end?
We talked to Nick Colas, and he said one of the things that dying industries do eventually was they buy their distribution. And he was telling us that in the context of Rolex acquiring Tourneau, which Tourneau is their biggest retailer of Swiss watches. So the biggest Swiss watch company bought out its biggest distributor. And this happens in every industry. We're seeing like CVS, Caremark. You see this everywhere. When an industry is not growing anymore, they buy their own distribution. So I think where this ends is you're going to see the asset managers start acquiring firms like ours.
Are you allowed to do that? Are you allowed to distribute your own funds through an RIA?
I think with enough lawyers, you will find a way, and they always do. And that's what I think is going to happen. So there are $500 billion asset managers that are subscale. We're in a world of Vanguard and BlackRock are 10 trillion plus. That's scale. 500 billion sounds like a really big asset manager, and it is, but it's subscale for the state of the modern industry. I don't know that they can just invent new index ETFs and catch up. Those categories are taken. So the next best thing is to own your own distribution. That's where I think that's my personal opinion. I think within 5 years, a lot of RIAs will have been bought up by some gigantic publicly traded asset managers. And not even to stuff funds through the channel. just because we are where things are growing and they need to add growth.
Oh, okay.
That's what I think is going to happen.
All right, got it. So I thought you were going to say as a way to get assets into client
Dude,
portfolios.
our business is growing. I think Chip Rome at Tiburon, the last slides I saw last spring in Boston, I think he's saying RIA channel is still organically growing 15% a year. Like that's the asset managers are negative.
So here's
And we're a complementary business. So I think that's what's going to happen.
I'm not going to completely dismiss what you said. There might be. There's two other avenues. One is ETF issuance, which now crossed 10,000. There's just getting sliced and diced. Every sector and subsector and sub-industry is being filled. The other thing is, what if they're just melting ice cubes? They're just gigantic melting ice cubes, and they continue to lay staff off, and they just continue to get fees.
I think they have to make a decision. I think they have to start buying up tech. They have to start buying up tech and own the platforms through which advisors and investors buy and sell and make decisions. That's one option. And we know a bunch of people in asset management that are trying to do that right now. And I think that's smart.
But the ice cube is just melting. The ice cube's not on fire. It's just melting.
They don't have to they only have to melt slower than the other ice cubes. You know what I mean? Like they have to find a new strategy. That new strategy is not going to replace what they're losing, but it could change. It could change the game up. It could change the rules of the game. If they all become fintech providers and own platforms, it's a better story. And that way, they still have this melting ice cube that's generating a ton of cash, and they have somewhere productive to invest that cash. So I think it's either going to be they want to buy the people who are closest to the clients, which is
know who did
RIAs.
this better than anyone. I hope I'm not speaking out of turn, but like obviously at a much smaller scale than say T. Rowe Price, but like O'Shaughnessy Asset Management, an active shop. They created Canvas, this beautiful tech platform that literally did not exist, and totally reinvented themselves. Really hard to do. Really hard to do.
All right, I'm going to do this little tax loss harvesting rant, and then we'll get into mystery chart and make the case. Let me do this quickly. I just want to put some people on to something that we don't talk about enough. We're not big seasonality guys, neither Michael or myself, but there is one type of seasonality that I have come to witness firsthand 20 times in a row, and it doesn't always work, but I know it's a thing that exists. I have some really garbagey stocks that I've been in since 2021 and should never have bought, and I've ridden them down huge to the point where they don't matter in my portfolio. Like even if they tripled, it wouldn't help because the better stocks have gone up a lot more. So it's just a relic of another time. And I was about to clean house, and then I remembered, wait, it's October. Mutual funds have a fiscal year that ends October 31st. So to lock in realized gains and losses, they have to be out of positions by the end of October. This phenomenon leads to rallies for the most beaten down stocks once the calendar switches into November. I know it shouldn't be that way, and everyone should know better, but it is that way. So if you have mutual funds holding a stock that's been down 70%, they will sell it down 80% just to get it off the books by the end of October. That seller is now out of the picture come November 1st, and you will see a lot of these shitty stocks levitate. So if you have huge losers in your portfolio and you do want to kick them or get rid of them, do it any time other than October when tax loss selling is becoming the most extreme in the smallest stocks where it really affects them. So this is some here. Throw this graphic up. This comes from Alger, but they're using a Bank of America study, and what they're basically saying is that there is a noticeable difference in TLC stocks, which would be tax loss candidate stocks. These are any stock that's down 10% or more in a calendar year through October. These TLC stocks tend to outperform the rest of the stock market from November through January by an average of 1.88%. This is data from Bank of America's quants that they looked at from 1986 through 2021. So basically, investors harvest equity losses for tax purposes at the end of the year. Mutual funds do it at the end of October. And once that selling pressure lifts, you see a big difference in the tone of these stocks. There are a lot of stocks that are down this year yet again, and the TLC candidates, the ones that are down more than 10%, don't be in such a rush to sell. You might get a better opportunity later this fall.
I'm thinking about a don't go chasing joke, but nothing's coming to mind, unfortunately.
What do you think about that? I know you're not a big seasonality guy, but what do you think?
No, it makes perfect sense. These are the rules. So sometimes seasonality doesn't have to be like voodoo. Like there's obviously like an explanation here.
I asked Sean what percentage of the Russell 3000 is negative year to date by more than 10%. 45% of Russell 3000 stocks are TLC candidates. That's high, dude.
Wow.
Tax loss candidates. 37% of the S&P 500 is negative by 10% or more year to date. So the S&P is down 1.15% for the month of October. Going back to what's that?
I mean, all right, fine, finish.
It doesn't matter. That's it. That's all I got. So don't be in such a rush this time of year. Give it a couple weeks. All right, go ahead. You're gonna make the case?
I'm gonna make the case. If you are in the camp that rates are at or near a peak, and you're looking to play rates in an instrument other than bonds, i.e. stocks, I think you want to. If I knew, okay, let me ask you this: if you knew that rates were going to fall, and maybe you asked this to me, or maybe Ben did, if you knew that rates were going to fall, would you be more likely to buy utilities or the ARC names?
Oh, that's a great question. For the initial knee jerk reaction.
Yeah.
I think I'd buy both.
Okay.
I could picture them going up equally as much.
So I would buy utilities, which I own, before I would buy those names, because I think that even though those are like also long duration assets, I think there is just no appetite for money losing companies right now. So chart on, please. So what we're looking at is a Goldman Sachs basket of growing sales and profit and profitable margins, right? That's the blue line. Versus growing sales and negative profits. So you could be growing your sales, but this is how investor preferences change, right? And clearly there is no appetite for companies that are not making money.
Dude, look at the timing of this. Look at the separation starts right when the Fed starts hiking rates.
Yeah. I mean, almost, there was March. Yeah.
No, that's not.
Oh no, March. It's March 2022. That's when we started hiking. I'm sorry.
So when did the separation really get real? Over the summer? Either way, I get what you're saying. Yeah.
Okay. So next chart. So these names have gotten killed. Like the interest rate sensitive stocks, obviously utilities are sensitive to interest rates being high the other way, like the opposite way of ARC. Those are super long duration. Who knows when you're going to get paid back? This is sort of the opposite in that these are like a bond proxy, at least for like some equity investors who owned utilities just for the yield. Well, there's really no reason. And also, of course, these companies are borrowers of money. So there's that too. So the double whammy. There's no need to get 2.8% of utilities or whatever it was when you can get 5% of cash. So these companies got killed and they're bouncing a little bit. Next chart also in the same vein, Verizon, another company. So Verizon is another stock that I own. I'm not up that much, so it's all good. But had a big day today on less bad than expected earnings reports. And then I just bought it a couple of weeks ago.
Look at it. I know, but look at it.
And then, I'm up 4%. I'm out. And then one other area that's rightfully being hammered by higher rates. That again, this is like if you think that rates are going to top out here instead of buying bonds, you can buy these stocks. Is Home Depot. Home builders are just getting destroyed, and then Home Depot obviously is, squarely in the epicenter of the frozen housing market.
I like this. All right, you want to do a mystery chart? I like this idea.
Go ahead.
All right. Let's do this quickly. Throw it up, John.
Feeling bullish.
Dow. All right. Dow component.
Is this weekly? Yeah.
Dow component.
Monthly,
hot sector.
monthly.
No, look, I'm going back 10 years with this bad boy.
But it's a monthly chart.
I'm showing you a 200-day moving average. Doesn't really matter. But this is 10 years. First of all, not knowing anything about this company fundamentally, buy or sell?
Buy, obviously.
No shit. All right. Okay. What is it?
This is a Dow component.
Yep.
Can you give me like anything else? Like
What do
there's
you
a lot
want?
of Dow components. I don't know. Like what does it do?
Well, we spoke a lot about this sector on the show today. Does that help?
This is Visa.
No, it's not a bad guess though.
Okay.
If I
Is it a financial?
no, throw it up. Because if I give you the sector, you're gonna know.
All right, fine.
You know what I mean?
Go ahead. Yeah, the reveal.
So it's all right.
Reveal?
You can't win them all.
Okay.
How
Wait,
good is
Conoco's in the Dow? This is the only stock in the Dow? The only energy?
No.
Or is Exxon in? Exxon's in.
No,
Exxon's in.
Exxon's not in. They pulled it out at the bottom. Chevron's in.
My bad. Okay.
Yeah. I don't know why they did that. ConocoPhillips looks fucking incredible right now. I mean, look at this thing, right? And this is over 10 years. Not like a fast money type of stock, but my God, is this thing positioned beautifully. So I don't own it, but I own it through the IEO, right? We have one more chart on this real quick. I know it's 6:01. Okay. Everything's going in the right direction. It's a dividend. Here's your normalized diluted earnings per share on a trailing 12-month basis. Here's your quarterly buybacks. This is a company that really does everything right. It's one of the highest quality energy companies in the world, and this is just year to date. So you got a little bit of a pullback here. I think I might just take it. I might take it. We'll see. All right. Thanks for playing. Hey guys, did you know tomorrow morning, Wednesday morning, is the day we get our all new episode of Animal Spirits with Michael and Ben.
We went
Make
hard
sure
today.
not to miss it. What's that?
We went hard today. Yeah.
Okay. Is that okay? Listen, I can't wait. All new Ask the Compound with Ben on Thursday afternoon. Get your questions ready. And an all new Compound and Friends at the end of the week. Thanks so much, guys, for joining us for the live tonight. Thanks for listening out there in podcast land. We'll see you soon.